All right, everybody, welcome to the Sherman Show. I'm Jeff Sherman here with my co-host, Sam Lau.
Hey.
And we have a very special guest today. He is none other than Grant Williams. He publishes the monthly newsletter, Things That Make You Go, And it's a deep dive. I've been working on how to say that. It's a deep dive, talking about all the thematic ideas in the global financial markets. I think really a lot of, we've been following you for many years on your publication, but I think you took a strange turn, a new turn last year with a really new series of podcasts. And I don't even have all of them. I saw it too. I think there's one with Stephanie Pomboy, like she's awesome too. There's one with Ben Hunt. We had him on recently, actually.
Yeah.
I know the one I listened to recently with Bill Fleckenstein as well. Always very informative. So maybe you can talk a little bit about what really pushed you that direction to launch those podcasts, and we'll come back a little bit more into your background. But I mean, those are some heavy hitters in the financial industry.
I'll be perfectly honest with you guys. What drove me to do them was boredom. I mean, it sounds ridiculous. I wish there was some kind of huge Machiavellian strategic plan involved, but there really wasn't. I mean, I was like everybody else back in kind of March, April of 2020, completely locked down. You hear, I'm in the Cayman Islands, and being locked down in the Cayman Islands is tough, right? I mean, they jumped on it early, and it was no one's allowed out of their homes except for an hour a day. And then they shut the beach down. You weren't even allowed to walk on the beach. So it's pretty harsh at the beginning. The back end of it now, we have zero COVID here. So life is normal. So it's kind of worked out really, really well for them. But during that lockdown period, like everybody else, I'm stuck at home. And, I have a lot of friends around the world in the business who I love talking to. And, I tend to pick people's brains as much as I can. And I love being the dumbest guy in every conversation I have. It's great to be that guy because you're always learning. And so I just figured, I'm going to have these conversations anyway. I'm going to be talking to my friends, and I'm going to be picking their brains about certain things. So, why not let other people listen in? Again, no real plan. I just figured I'll set a bunch of conversations up. And so that's what I did. And, I thoroughly enjoyed every one of them, and we kind of built an audience. And then later on last year, Bill Fleckenstein and I have a mutual friend in Mark Cahodes who called us both up. And when Mark calls you and tells you he wants you to do something, it's tough to say no to. And he said, you guys should do a podcast. So we started the End Game, and Steph and I had been talking about doing a podcast for some time. So we kind of lit that up with, she's called the Super Terrific Happy Hour. We're both huge Seinfeld fans, so that's where that title came from. And Ben and I, whenever I talk to Ben, I just love my conversations with Ben. They're so different to the normal financial ones. So he and I started a random series of podcasts called The Narrative Game, just where I could pick his brains about the prevailing narrative, as you guys have done in your podcast. And so each one of those three streams, all very ad hoc. We have no publishing schedule. It's not like we're set to doing one a week or whatever. So we do one when we feel we've got an interesting guest or an interesting topic. And they've been great. And people have thoroughly enjoyed them. We've had great feedback and great audience. And I think for us, for Bill and I and Steph and I and Ben and I, just really interesting conversations that have been fortunate to attract a bunch of fantastic guests who are all kind of interested and keen to share their thoughts on stuff. And it's interesting. The one thing that's kind of worked its way through so many of those podcasts is this inflation versus deflation debate. That if I had to kind of pick one topic that's been common to everything, that to me, with perhaps volatility as a close second, but this idea of, are we about to enter a secular change and move into an inflationary environment, has been the one thing that there's been great disagreement on both sides. But the beauty of this is everybody we've had on is so smart about these things. So whether you're listening to Lacey Hunt talking about how deflation is still in our future, here's a guy who's been right about it for 40 years. How do you count him out? But he's being countered by Russell Napier, who's been hardcore deflation for 20 years and now is a staunch inflationist. Russell's thought on this is extremely thought-provoking. So to have those great minds debating this, maybe not in lifetime, but it just gives the listeners so much to think about. And I, personally, I think that's the one thing that everybody who has an investment portfolio has to think through, is that, can I continue with a portfolio that does well in deflationary times? Or do I need to start thinking about adjusting it for oncoming inflation? Because if inflation is in our future, then there's very few portfolios in the world that are set up to handle that effectively the way they have been for the last 20 years.
Yeah, and I think one of, I mean, Lacey's arguments are so strong, they're
Yeah.
profound. You go through it and you scratch your head and say, why shouldn't I just buy, 30-year zeros or strips in that market? And you're right, they've been positioned for it very well. And I think one of the interesting things is that he still points out the thing that can derail that idea is that if the Fed's liabilities become legal tender, right, where
Yeah.
they actually get in the true currency game. And that's probably a little deeper than we want to go right now. But forget your background, Grant. You jumped off. This is a topic we're going to talk about so much about you. Let's talk about the inflation deflation camp. So, where do you see yourself in this debate today? How are you thinking about it? Are you thinking about it? Inflation as a 2021 phenomenon? Is it something that is a couple years out where these policies need to compound? Where are you thinking about it, and how are you trying to advise people on their portfolios for this rearing debate that we're having?
Well, for me, the way I handicap it is this: I think inflation is in our future, because, as we all know, at this point, it's essential that they try and create some kind of inflation. Without it, the central banks are really in a corner. But at the same time, if they get it, you better be careful what you wish for, because it's going to cause all kinds of problems. So this is why I think it's so important for people to have a view on this. And look, none of us know. I mean, that's the first thing to understand, is none of us know if deflation or inflation is in our future. And so what I keep saying to people is, look, you need to go through the mental exercise. Look at your portfolio, think through what an inflationary environment would reveal in terms of the stress points in that portfolio. And at that point, you then have to start thinking about handicapping its likely return. And if you think it's an unlikely event, which many people like Lacey do, and David Rosenberg, I had a great conversation with him and Steph a couple of weeks ago, and Rosie's very much talking about the fact that deflation is here for the short term at the very least. If you think that's the case, then you don't need to really adjust your portfolio right now, other than to be aware of what you probably need to do if that opinion changes, if you think inflation is in the likely future. Um, I think where we are is that we probably are likely to see deflationary forces prevailing in the short term, but I think that short term is getting shorter by the day. I think the short term deflation a year ago, you could probably say, well, short term is maybe another 2 or 3 years of this. The Fed have obviously promised they're not going to change rates till 2022 now. I lose track of how far out they're pushing that. Um, but I feel like with all the dry powder that's been pushed into these markets, and the future dry powder that you're going to see coming into the markets in terms of additional stimulus, um, that makes me very nervous that we could get inflation picking up quite quickly at some point. So for me, it's an exercise that I think people do need to go through now, and understand the stresses it creates in their portfolio. I think if you look at the commodity markets, you're starting to see signs that they are sniffing this out. You're starting to see very constructive chart patterns in all the base metals. Really, we've seen obviously gold and silver are acting not really. It's not really an inflationary bet at the moment. It's a real rates bet. So I see enough signs that, for me, I think you need to do the work now. You need to go through your portfolio and stress test it for inflation. We're seeing a curve steepen. There are all kinds of signs that suggest it's an important exercise to go through. So for me, I wouldn't shy away from starting to nibble at inflationary trades, even though they may not work for the near term. I feel like the damage that you're going to be potentially suffering if you are starting to set up for inflation at this point won't be too significant. You have to be careful. I don't think it's that you go all in on the inflationary boat, as some people are. But I feel like if the change isn't here, then it's certainly something that you can maybe see from here. And I think it's arguably the most important secular change that we have to deal with in the last 40 years potentially.
Right. Well, we haven't really seen, elevated levels, at least since we've had this kind of in the direction of downward pressure on inflation. Like, over the last 40 years, you had elevated levels, but we haven't really had those spikes back. And so when you're thinking about, positioning, and you're talking about trying to leg into those trades, you mentioned commodities. Commodities have benefited pretty well in this whole reflationary idea. You're starting to see finally the energy complex as well kind of participate in this rally. You mentioned gold, a real rates trade. Well, one thing is if inflation comes in and rates aren't moving commensurately, it's obviously a real rates trade. But we've noticed break-even spreads continue to really be on a tear. That is, people buying tips or inflation-linked assets here in the U.S. That they're really starting to look like the market feels that there's going to be a true level of inflation, even like 5-year rates. We're not just talking about the ones that
Yeah.
are correlated to oil. What are some other trades that maybe aren't as crowded, or things you need to think about that investors don't really talk about when they talk about inflation? We always hear about inflation linkers, we hear about gold. What other things are you thinking about when looking at that portfolio of what can help in this somewhat perhaps inflationary environment?
Well, I think for me, what's important if we do enter a period of inflation, or we start to get, and don't forget, inflation is all about expectations. That's why I think you're seeing those things you've seen, is that people's expectations are starting to get there. And sometimes that's all you really need to get this trade moving.
Hmm.
But for me, the important thing is, if we do go that way, if we do see a change from a deflationary environment to an inflationary environment, then the beauty of it is, as an equity investor particularly, is that it just changes everything. And so if you look at what's worked, if you look at momentum stocks, for example, I mean, it's been just the place to be, and value is just on the nose. I mean, nobody wants to own value stocks. Nobody wants to invest with value managers. And a few value managers that I've spoken to are starting to see people, make inquiries, and they're starting to see inflows. And that tells me that there could be a tremendous tailwind to that trade, because value is so unloved at the moment. And there are places you can go in these markets where you can go and look at the stuff Jeremy Grantham talks about, right?
Right.
Poor Jeremy. There's stuff there that if we do get a change in that big secular environment, it's going to flip everything on its head, because an inflationary environment is going to behave tangentially opposite to the deflationary environment we're in. So it kind of gives you almost the ease of saying to yourself, well, look, I just going to park some money in value ETFs for now, just so that if we do get this change, I want to own all the stuff that's been out of favor. Because if you've ridden that tailwind of the FANG stocks, and you've ridden those kind of tailwinds, you are going to see people looking to sell those and looking to lock in profits. And where are they going to go? They're captive to the equity market. People are going to want to be in equities if it is an inflationary environment. And so you just have this beautiful setup where there are some great companies and great sectors that are really, really downtrodden and sold out, and nobody wants to own them. So even small caps, again, there are small cap indices, and the beauty of the ETF environment is not everybody has to be a stock picker anymore. And because of the way a lot of this passive money is allocated, it will get allocated to value strategies, not necessarily value stocks. And so you can sit quietly and say, okay, I'm going to start allocating to value away from growth, away from momentum, just quietly at the edges, and just give yourself a kind of dog in that hunt and the ability to participate if it does shift down. The thing that worries me is if we see this inflationary button switch, and we do see people start to try and really flip their portfolios on their heads, I do worry about the effect that this passive phenomenon is going to have as people try to move to the exits in what are very, very crowded trades in, for example, the FANG stocks. There's plenty of people who've been talking about this, not least of them Mike Green, who's done an enormous amount of work at Logica Funds on the passive phenomenon. And one of our podcasts that Bill and I did in the early days of the Endgame was with Mike, and the conversation we'd have with him about what could potentially happen because of this massive shift to passive investment if the market turns south and passive starts to do what it's been doing on the upside to the downside, is actually quite frightening. And I would encourage people to look for that and listen to what Mike says about, when he talks about the market could theoretically go to zero. It's a great headline, but when you listen to the reasons why, and I wouldn't dream to paraphrase what Mike says, because the depth of his thinking is so extraordinary. I think it's a really important thing to understand just how damaging this great tailwind to the upside could potentially be to the downside.
Yeah, you point out Mike. I did an event with him. I think it was late last spring during the market turmoil, and yeah, he's brilliant. Not to mention, he has a great Twitter handle. I think it's Professor Plum or something like that.
Prof Plum
Prof Plum,
99.
yeah. So that's a killer one. So shout out to Mike there. So as you're talking about the sea of change, and what's missing here always is the catalyst. So you talked about expectations, of course. You talked about perhaps the Fed wishing for inflation, and be careful what you wish for, you may get it, because the expectations drive it. What else can you see as a catalyst here? I mean, we've talked about money printing. We've seen M2 velocity increase M2 supply increase massively last year, highest prints on record in the US. We're talking about running massive fiscal deficits again. What are some of the catalysts that could actually drive that new inflation narrative?
Well, I think the thing people need to watch out for is just outright currency depreciation. So it's not really, it's the tail wagging the dog. And if we continue to see the amount of deficit spending we're seeing around the world, at some point that is going to manifest itself in currencies. At the moment, it's still kind of a relative game,
Mhm.
and you're still seeing volatility in currencies, and you're seeing the euro going up at the expense of the dollar, and then things turning around. But at some point, when this spending starts to really take off, and I think the next wave of stimulus spending is going to be the thing that potentially could trigger that. You are going to see people wanting to get out of currencies, and that is where you're going to see people start to move into commodities as a safe haven. I think we're seeing some of that in Bitcoin. We've seen a little bit of it in gold, but not too much. But when you start to see people losing faith in currencies, that will be quasi-inflation. Uh, Also, I think Janet Yellen talked about today. I think my friend Dylan Grice put a great tweet out. Janet Yellen had talked about how, the Fed has all the tools to get inflation under control should it start to get out of control. And Dylan made a great point when he retweeted this. He said, "Yeah, we know you have the tools, but do you have the stomach to use them?" And
Right.
that is absolutely the most important question, because we know they have the tools. Right? The tools, as Paul Volcker proved, are
Right.
double-digit interest rates, right? But we
Right.
all know that's completely impossible at this point in time. And I would posit that 3% interest rates are unbearable at this time. So, yes, the Fed has the tools. And so, at the first point in the road where market investors, not necessarily a retail crowd, but sophisticated market players, see a situation where the Fed have their feet held to the fire and said, okay, well, we know you have the tools. What are you going to do? Do they blink? And I would argue that they have no choice at this point but to blink. Um, and if they do blink, then I think the inflation trade is well and truly on. If they don't actually tackle inflation, and look, they've already started to give themselves some kind of runway by being very careful to talk about how they are going to be quite happy to let inflation run a little above 2%. Maybe we'll let it run at 3% for a little
Right.
while
Right.
to even out where we've been below that. But as you well know, guys, 3 can turn to 4 fairly quickly, and if 3 turns to 4 and 4 starts to look like it's turning to 5, then they have something important to do. And at that point, if they don't come in and and actually do something, rather than, let's say, jawbone and say, well, we think this 5% is transitory. That's always a great word that they use.
Right.
5% is transitory. I think at that point, a lot of market participants have no choice but to assume that this is going to get away from them, and that, I think, could be a big shot in the arm for this inflationary trade.
Yeah. I like that it's always transitory when it doesn't achieve their objective, right?
Right,
It's not
right.
to just that it misses. It's only transitory when it doesn't go into my narrative that I'm trying to spin here. So we haven't talked about the growth aspects too. So, some people are cheering on some form of inflation. You kind of alluded to this at the beginning of just to help pay for the deficits that we've been running, not just in the US, but the developed world as a whole. What do you have on the outlook for the growth? There's been a lot of hopes in asset prices based on the vaccination, the success of that. People keep focusing on we're going to get back to life as normal. I don't know what's normal. It sounds like the Caymans, you're back to normal down there. But what do you think about in the growth prospects? Do we have some irreparable damage within labor markets that's going to take time, truly be transitory to change people? How are you thinking about the growth environment? And is it just because we'll have a low base starting, in the second quarter here in the US, that it'll look very strong, but it's just truly transitory and temporary coming off the base? Or do we really have the tools to set off a catalyst for a new growth regime? Because I want to remind everyone that as we think about it, since the global financial crisis, the annualized GDP in the US has been about 2.3%. So that's trend line growth, right? Can we get above that? How are you thinking about that? And just, what do you think for the prospects for just the growth environment?
I think it's such an important question. It's great that you actually made that point about what trend line growth has been. it's been weak. The world struggled with, if the US has grown at 2.3% for a decade, that's not been great. But what we have had previously was China growing double digits, India growing double digits, Asia. There were places around the world that were picking up the slack. What we're now seeing is kind of this, everybody's suffering from, let's call it lower growth instead of low growth. Countries are growing, and yeah, we've got some nice comps coming up. But when I had that conversation with Rosie recently, the numbers he was pointing out, and nobody digs into the data better and deeper, I think, than Dave Rosenberg. And there's been an awful lot of ink spilled and keyboards punched to try and generate this idea of this V-shaped recovery, because as always, it's always very important for that mental side of people to be invested in a V-shaped recovery, because obviously sentiment leads the reality. But what Dave's found when he looks into the data is when people are talking about, there's been this surge in DIY spending at the Home Depots and the Lowe's, and there's been a surge in people fixing their own cars and all that kind of stuff. But as Dave pointed out, we're seeing double-digit rebounds in things that equate to about 4% of GDP. So it doesn't really move the needle. I think the damage to the economy, it's not irreparable, but it's going to take a significant amount of time for us to get back to where we were. And that's kind of been masked by these stimulus checks. I'm from the UK originally, and there's been an extraordinary amount of stimulus pushed out, $300-400 billion by the Chancellor of the Exchequer right now, which is absolutely unaffordable for the UK, completely unaffordable. And now, obviously, we're starting to get to the point where the rubber meets the road, and we're going to have to start talking about taxes. There's a lot of discussion in the UK about windfall tax grabs against the online retailers, Amazon. They're calling it the Amazon tax, because these guys have made hay, obviously, while the sun shone, and meanwhile, high street retail is completely a dumpster fire in the UK. And so I think you're going to start to see a lot of these countries that have massive holes in their budgets are going to have to find money from somewhere, because look, we all know you can't just continue to print it and throw it into that hole. At some point, you need to take it from somewhere. And the only place you can take it is from the people who have it. And on the basis that the number of people who have that wealth has declined over this last year, it means the taxes are going to have to be bigger on the haves, on the Amazons of the world, on the Googles, the Netflixes of the world, the guys who've been making money. And that's going to cause more problems. So I don't think we're going to get back to trendline growth consistently for some time. What interests me is at what point does that kind of reality start to seep in, that yes, the band-aids put on by both fiscal and monetary policy have done a great job, but we can't do that forever. It doesn't work if that is the solution to sub-trend growth. And if we realize we can't do that forever, where does that come home to roost? Does it come home to roost in the currency? Does it come home to roost in failed bond auctions? Well, in the EU, the ECB bought 85% of sovereign issuance last year and 100% of the southern Mediterranean countries. How much more of that can they do? Well, in the sense of the European countries, obviously, the southern countries, they're at their limit, but it doesn't mean to say they won't keep doing it. Can they buy more than 85% of Northern European issuance? Clearly, they can buy 15% more. But at what point does that start to matter to the euro? Do these enormous deficits in the US start to cause problems for treasury auctions? And if so, do the Fed start going down that playbook that Japan's followed, that the ECB's followed? Well, you'd have to say that, yes, that's what they're going to be forced to do, because I don't see any way that we can get back to 3-4% growth, which with these larger deficits is what we're really going to need to try and chip away at that. Sorry, this was my dog barking.
Yeah, the dog doesn't like your big deficits.
No. Well, he's convinced we're going to see 3 or 4, so he always gets upset when I talk about this. But that's what I think the problem here is that you're pushing a rock uphill to create the kind of growth that you need, and sooner or later, I think somewhere that has to be reflected. It's certainly not been reflected in risk asset prices for reasons that we understand fully with all the amount of stimulus that's going on. But at some point, I think this realization that what we're doing to keep the wheels on is only justifiable if a return to trend growth, and ideally above it, is in our future. And I think what time is perhaps going to tell us is that return is getting pushed further and further out, And at some point, something has to give, unfortunately. And I suspect it's either going to be the bond market, the currency, or both.
Yeah. Well, I think when you look at it too, it's one of those kind of ideas where, well, we did all this extraordinary measures, they work, so this is going to be the playbook going forward, right? I
Yeah.
mean, QE was an extraordinary event. Now it's just talked about as policy. I mean, Jay Powell himself says it's part of the playbook. It's one of their tools, right? And so I think you have the same thing with the fiscal authorities. It's that, well, mailing out checks, or making sure that we have a better backstop and band-aid when there's unemployment, right? And so it's not going to the root of the matter. It's those temporary fixes that become somewhat
Yeah.
permanent, and then we just compound those policies, and then we look back and say, how the heck did we get here, right? And I think that's kind of one of those moments you're talking about. And where does it impact which market? Is it currency? Is it inflation? And by extension, the bond market there? Or is it something?
Jeff, it's interesting what's become our barometer for success with those policies, right? Because success from an economic standpoint has been the system not collapsing, right? It's been avoiding a Great Depression.
We all root for that. We all root for the
of course,
not to collapse. That's good, but
of course
that should be the bare minimum, right? That shouldn't be success. That should be the bare minimum, right?
But how we're measuring it is in risk asset prices. We're talking about the stock market being at all-time highs and junk bonds being at all-time highs, and we're talking about these risk assets floating higher as success. And I think market practitioners understand that's not success at all. In fact, that's arguably failure. It's great if you're in the business and you have access to liquidity and you can get leverage and you can run these things up because you have that implicit backstop. But it's anything but success, because it's hollowing out the economy. It's hollowing out the middle class by taking away any ability to generate income on your savings, and yet it's being kind of held up as success. And I think that's very dangerous, because what it does is it tells the middle class, it tells this famous 99%, hey, success. They've hung the mission accomplished banner on the deck of the aircraft carrier.
Right.
When people are struggling to pay rent and they're reliant on $600 stimulus checks, but they're reading about how Elon Musk and Jeff Bezos made another $15 billion last week because their stocks went up. So I think it's very dangerous what the barometers of success have become right now, to be honest with you.
Well, so on that note, very, very prescient topic here in the U.S. has been the Reddit army, right? And that how they're trying to democratize finance. And so some people look at all of us working in the business, being institutional investors, that perhaps we're the bad guy in all of this. But what do you think about this movement? I mean, it reeks of stuff where you saw in like the online forums back when they had the I forget what they were called, the little chat rooms, like the IRC rooms and things like that, where people were getting together. But you talk about depressed savings rates, right? The inability to earn a decent return on capital through your bank or wherever you do it. So you have to take risks. Is this a response mechanism, or is this just utter speculation and people trying to get involved and make a quick buck? Which again, finance is predicated on that. So no disrespect to those trying to do that. It's utter speculation, or is there a bigger movement underway? How do you feel about all this?
It's a great question, and I think it's a really important thing for everybody to kind of think about. And I don't think there's a simple answer. I think what's interesting is so many people on Wall Street are cheering on these retail investors, right? There are plenty of us that go, look, I hope you all sold your GameStop shares at 400. Because I think that would be phenomenal if you did that.
Phenomenal, and bag it and move on and just be happy. Consider the trade of a lifetime, right? Yeah.
That would be amazing. If Main Street actually did clean out Wall Street on that one trade and take the $35 billion and put it in their bank accounts, no one will be happier than me, nor you or nor Sam, I'm sure. And there's a lot of Wall Street guys that are cheering them on. Unfortunately, what we recognize, I think, after years in the business is that it's not as simple as that. And that's most likely not what happened, but just because of the nature of the way these kind of retail manias tend to go down. And unfortunately, they do tend to happen the same way. And finance is not a simple science. It's a complicated, convoluted practice. And buying shares of GameStop, or more importantly, perhaps in this sense, buying call options on GameStop is not a simple thing to do. I think Wall Street made an awful lot more than Main Street out of those runs, unfortunately. And I think an awful lot of retail will have been sucked in at the top and will be sitting on significant losses. And unfortunately, with this kind of gambling culture and everyone locked at home and looking for kind of ways to play the market, um, it's one thing to put your $600 stimulus check if you're a millennial living at home with mum and dad, and it's kind of free money and it's landed in your lap and you've kind of got involved on the boards and it's all fun and games. That's one thing. But there are plenty of people, thousands of people, and you're starting to see these awful stories appear on the bulletin boards now about how the people who put all their money in GameStop at $400 and 2 days later it's at 60, and it was money they couldn't afford to lose. And I think it's a tremendous shame. I really do. And unfortunately, this idea that we're sticking it to the hedge funds. Look, Melvin Capital had its problems, and I don't think there were too many people on Wall Street that were experienced too much sadness at the kind of fate that befell Melvin. If you're that levered and this happens, we all know what's going to happen in the game. But to recast that as Main Street sticking it to Wall Street is unfortunately wide of the mark. And I think that what happens from here is complicated enough that reducing it to, you know, diamond hands and never sell is to miss the point, and is actually going to funnel an awful lot of money back into the pockets of Wall Street, because this isn't like going to the casino where there are one set of rules and the house has an edge. You're going into a casino where the rules are actually really, really complicated. And while the game prima facie looks very straightforward, you put your money and you see what happens. The rules, as we found out with the Robinhood margin call, what Robinhood did, anyone who's in the game and understands how clearing brokers work knew that that wasn't necessarily Robinhood being bad guys. They had a $3 billion margin call they couldn't meet, and so they restricted trading. We understand that's how it works. The narrative on the bulletin boards was Robinhood are bad guys. Now, the big problem with that, and I've spoken about this before, is that the CEO of Robinhood went on CNBC and lied. He committed serious securities fraud. He said we didn't have a margin call. It wasn't anything to do with that. Later on that night, and here's where the problems of social media appear, in a clubhouse sitting where Elon Musk is questioning him, he comes on and says, we had a $3 billion margin call that we couldn't meet that morning, and we talked the regulators down to 770 million. And then we went out and raised 2.4 billion from investors. So a big problem of this is the enabling and the kind of, again, hollowing out of regulation by likes of the SEC in terms of policing this and allowing the likes of Elon Musk to commit securities fraud in plain view and slapping him with a $20 million fine. He's made billions of dollars from the increase in the stock price from that securities fraud. And if you take away, as someone said to me, I forget who said it now, but someone said to me that you know, capitalism without bankruptcy, without fraud charges, is like Catholicism without hell. And it's so true. You know, you have to have the fear of telling lies and committing securities fraud and going to prison for this stuff. And it's absent. So the market has become a casino. And unfortunately, it's a casino with very, very complicated rules. And the new guys at the tables don't get that. They think it's you roll the craps, you roll the dice, and if it comes up the right number, everything goes up forever. And it's a great shame to see these stories. As I say, I hope everybody who's in this on the retail side gets their Lambo and walks away, because that would give me put an enormous smile on my face, I have to say. I fear the worst, though.
You sound more like a crypto guy if you're focused on Lambos, but I'll let Sam ask something there. Yeah.
No, I mean, it definitely marks an interesting shift in the market dynamics with the retail investors coming in, and like you know, Jeff and I were cheering them on, in terms of just letting the so-called little person win in this. But it is something that the regulators certainly have their eyes on. Last week the Yellen pulled together the SEC and the CFTC. They determined that in terms of the market functioning aspect, it was sound, but lo and behold, they're investigating to take a look at each of the actions that were undertaken by the participants. And in both chambers of the House, I believe they have committees that are looking into this as well. But it's just amazing to watch. It was incredible to watch the level of coordination that was required, and the cohesion that they maintained on the way up is always good. But once you reach that top, and when people start getting a little bit itchy on wanting to pull out, that's when the cohesion starts to fall apart, right? Each person is their own leader at that point. So I think the parlance is the diamond hands quickly become paper hands in that, and yeah, you descend back to earth. But one of the things I wanted to touch back with you on, Grant, is you mentioned earlier on that you're in the Cayman Islands. Um, Wondering if you'd be open to sharing, some of the factors in your move to that, to the Cayman Islands from where you were previously. I know here, bringing in some of the discussion topics that we had earlier here in California, at least, the topic of the last year or so, especially as we've been shown the ability to be able to work from home, from some extent or remote working. A lot of people are contemplating whether or not they should be picking up and moving from high cost, high tax type states where you see the costs increasing and only forecasted to increase into the future as well, and replacing their locations to something that is of a lower cost like Texas or
Yeah.
Arizona, New Mexico. But Cayman Islands takes it to the extreme. It's a big difference there.
Well, it does in some senses, and it doesn't in others. I think this is a low tax, high cost environment. So the cost of living here is astronomical. I moved here from Singapore, which at the time was the number one most expensive place in the world to live, supposedly, when they do that chart every year. And this place is as expensive as Singapore. Now there is zero income tax, but that doesn't help you if you're an American. You're taxed worldwide. So consequently, there's a surprisingly small amount of Americans here, considering we're 150 miles off the coast of Florida. There's a lot of Brits here. There's a lot of Aussies here. Other countries that don't get taxed globally. This is a good place to be. It's a good place to have a company, but it's funny. There's a great amount of stigma attached to the Cayman Islands. It has this reputation that anyone here must be a drug dealer or a money launderer. And I can assure you, you can use this in any testimony that I'm not either. But trying to set up a business here and get bank accounts open, for one of the world's leading banking countries, supposedly, the banking system here is abject. I mean, it really is just incredibly difficult to get decent banking here. So I think there's an awful lot of things going for the Cayman Islands. I moved here; it had nothing to do with tax. I really moved here because the business I co-founded, Real Vision, we based here simply on geographical requirements of wanting to be in the same time zone as our biggest market, which was the US. But because all the founders were not US citizens, we didn't need to put ourselves into the IRS noose at any point in time. So it was really a geographical decision. And it has a lot going for it, but it's a very small place, and that never really reared itself as a problem when one could travel around the world freely. Because anytime you were here for an extended period of time, if you wanted to go to Miami, to a city, or to New York, or to Dallas, or anyone to go to a city and experience a bit of culture and life and restaurants and theaters and whatever, it was a really straightforward thing to do for the weekend. But once you shut the borders on a place like this, it becomes a very small island very, very quickly. And while it's everybody's idea of paradise, crystal clear blue waters and sunshine and beaches and zero COVID and no restrictions on gathering or any of that stuff, which is fantastic, you can't help but get claustrophobic being here for a period of time. So they've done a great job in dealing with COVID here. They've done a remarkable job. The government has really outdone themselves, I think. But it's wreaked havoc on the tourist industry, as you'd imagine, which is by far the biggest thing here, apart from legal and compliance and hedge funds and stuff. So I wouldn't be surprised to see next year taxes being imposed upon those kinds of industries to try and cushion the pain felt by the tourist industry. But I don't think anywhere today is either a 100% great solution, or somewhere where if you don't get taxed on an income basis, you're not going to get taxed on a VAT or a duty basis. I don't think I think the days of low taxation jurisdictions are pretty much gone now, unless you want to move to somewhere like Vietnam or Cambodia, or places that are really not in the mainstream of finance. I mean, beautiful countries, both of those. But Hong Kong used to be an incredibly cheap place to live, not anymore. Singapore used to be a pretty cheap place to live, not anymore. So I think those days of kind of first world exotic countries being tax-friendly jurisdictions, I think you can pretty much put a pin in that now, to be honest with you.
Yeah, well, it's kind of depressing. But again, it's what happens when people move in, right? It's like
Yeah,
we move there for no income taxes and we don't use all the resources. So at some point, the piper has to be paid.
yeah.
So I guess one thing we've been talking about was the inflation side. There's a lot of consensus ideas out there today. And I think it seems to me that the market seems to be pretty lopsided in some of these ideas that inflation's coming back, like the dollar devaluation. Stocks are the only game in town. What do you think are some of the risks out there that people aren't talking about? Because when consensus builds like this, again, a lot of it's momentum driven, the trade's on, people are making money on it. It feels very comfortable. We used to always say that there's nothing like good like keeping that low cost basis stock in your portfolio to remind yourself how smart you are, right? Look at that. I did a great trade, right? So, what are some of the risks out there that people aren't talking about or that you see that we should be discussing more?
Look, to me, the two most important risks to understand, one is volatility. And I don't just mean that from a market perspective, but I think we have to understand societal volatility. And we are at a point in time where suppressed volatility is everywhere. And anytime you suppress volatility, at some point, it's a naturally occurring phenomenon. It is going to explode at some point. And because we've become so used to dampened volatility, and because we've become so used to it not really being something we have to worry about, the short vol trade has been a great trade for such a long time now. It's also led to the other thing that worries me, which is correlation. As you said, right, everybody's in the same trades, everybody's on the same side of the boat. And anytime you have that extraordinary correlation and you have extraordinarily dampened volatility, particularly I think away from markets, political volatility, societal volatility. These are things that you can't measure with numbers. You can't look at your Excel sheets and your quant models every day and predict the storming of the capital, for example. And while those things haven't necessarily had any kind of long-term negative effect on risk assets, as that tends to increase and gets broader based around the world, then you do reach tipping points where people start to decide that volatility is either underpriced and they want more exposure to hedges for it, or you start to see volatility take off just because of the sheer number of people that want protection. And we haven't really seen that for a while. And that comes back to this belief that the Fed and the other central banks and governments have this all under control. And I think what the events of January showed us was that that control is extremely fragile. And whether it be in Washington, D.C., or it be the ongoing Gilets jaunes process in France, which have been going on for a couple of years now and just don't get the coverage that they perhaps warrant, or the stuff we've seen in the Netherlands, or the stuff we've seen in Austria, right across mainland Europe, normally pretty peaceful countries. And for this stuff to happen in the winter there, when nobody wants to go out and protest, you kind of expect this stuff in the summer when it's nice and warm and everyone's, protesting out in the squares in Spain and everything's great. But to have people in Holland protesting violently in the streets in January tells you that something has changed. And so they're the things that I think people need to pay more attention to is understanding how fragile the social fabric is, understanding that this conflict, which is kind of amusing when it gets memeified, okay, boomer and all this kind of stuff is you're kind of funny, but there's an undertone to that which is rooted in haves versus have-nots. It's rooted in a transition of power that the millennial generation want and feel like they are old enough and responsible enough to take the reins of power. And let's face it, they are. The leading wave of millennials approaching 40 now. So it is their time. And one thing I'm looking for is, when we start to get elections, whether it's midterms in a couple of years or other elections around the world, is start to see how young politicians start to poll. Because I think if you start to see surprising results in terms of 35-year-old 40-year-old senators starting to get elected at a fair clip, or across there in Europe you start to see young politicians, that tells me that this power struggle between the boomer generation and the millennial generation, with Gen Xers like me just caught in the middle, having never really had our hand on the tiller at any point in our lives, what that signifies is a redistribution, because once that power structure changes, it gives power to the people who are the have-nots and who have not done well over the last 50 years, as the boomer generation have, look, by no fault of their own, by pure coincidental good fortune, happened to be born in the 60s and have ridden this extraordinary 50-year wave to great prosperity. But unfortunately, the last 20 years of that wave of prosperity has come at the expense of millennials and Gen Z largely. And so if they start to take the reins of power, which is going to happen, let's face it, even if it has to wait till the boomer generation largely dies out, they are going to want to make things right for their generation. And that is another power struggle, which I don't think investors are correctly positioned for. I think it will be very confiscatory. And if you get to a period where we reach confiscatory policies, let's face it, the only people you can confiscate stuff from are the people who have it. And it's very, very clear where that wealth sits right now and where it doesn't.
Yeah, I mean, there's a lot in there. I mean, I think it's just a great way to end it, Grant. I mean, just to give people food for thought too, that it's not just about markets when you talk about suppression, but society and just the impacts we have. And at some point, we're talking about having more equitable policies, making sure more people participate. It's even on the Fed's docket these days. You hear that a lot more, right?
Yeah.
About talking about that and trying to fix that. So I think it's a great way to end it. But, Grant, one thing before you leave, I got to introduce you to Sam's favorite part of the show, because we've got to get into that real quick. So,
all right,
thinking cap, here we go.
I'm ready.
All right, Grant. And my favorite part of the show is Sherman Says, where I will offer a series of unique alternating prompts between you and Mr. Sherman here. Now I'm going to start it off first with Jeff at $15 minimum wage.
Bring it on. We have it here in California, right? It doesn't apply great everywhere across the country, but you want to get inflation, let's start with $15 minimum wage. All right, we'll see the Fed stomach at that point, right?
I think this $15 minimum wage, it's like the 6-minute abs in the wrong direction, like you had in Something About Mary. It's $15 minimum wage. What about $16 minimum wage?
Right, exactly. But the 6-minute abs is like the 5-minute abs, right? Yeah, right, exactly. So, yeah. No, look, I mean, it works here in California because of cost of living, right? And it's reflected in pricing. But does it work in Alabama? Probably not, right? So.
Yeah, and that's what they're talking about at the national level now. It was interesting to see that actually Bernie Sanders, of all people, was against it, at least for now, just because of the economic impact it would have on already struggling businesses, right? So,
well, you have to think about it this way too. When we did it in California, it didn't happen from 7 to 15. It was gradual steps. I mean, we've been doing $1.50 a year, and it was depending on business size as well. So smaller businesses were lower than the other one. So there's ways of implementing that. It's not like it goes overnight and your inflation shows up. But as we've noticed, there's a burrito place, or there used to be, called Ocho, and our joke when it first came in was everything's $8, so it's Ocho, right? Now we call it like quince. It does get up there, So anyway, it's moving in the wrong direction there, but that's assuming that they're still around. We haven't been there in a year. So anyway, yeah. we got to one prompt, Sam. This is your goal here, right?
All right, here we go. I'm gonna keep you guys moving with the next one to Mr. Williams with fiscal spending.
Oh, how high can you go? I mean, they are going to be throwing multiple trillions at this. I think we've just seen the tip of the iceberg so far.
Back to Mr. Sherman with Wall Street bets.
Good luck. Look, it's a hard game. It's a hard game, and look, you get it. If you guys are crushing it, keep crushing it.
Yeah.
No one here is rooting against you. Just be careful, know what you're doing. Realize when something goes up to 20x or 30x, it doesn't tend to keep doing it in those multiples. So size accordingly, learn how to size your bets.
All right, back to Mr. Williams with short sellers.
Unfairly vilified. Learn the difference between short sellers and leverage shorts, and the kind of the short sellers who are the opposite of pump and dumpers. No one really vilifies pump and dumpers, which is what the kind of scammy shorts are on the downside. They get themselves short, put the retail out, put the report out, and then cover them. But short sellers like the Mark Cohodes of the world, who identify fraudulent companies, Enron, Tyco, WorldCom, all exposed by short sellers. Leverage shorts is another matter. The Melvin Capitals of the world, leverage shorts. The rules going in, and you get what's coming to you ultimately.
Yeah,
Don't
I
get
mean,
caught
you
offsides
got
on
to
that.
yeah, you got to give Jim Chanos a shout out there too,
Yeah,
right?
and absolutely right.
And you
Absolutely
do
right.
it right, you do it accordingly, and you're right. It's leverage that kills you more than anything, both directions. So.
All right, back to you, Jeff, with bipartisan. I'll throw in the ship after that. Bipartisanship.
Okay, a ship of people who act like they get along, huh? I'm hopeful. Let's say hopeful. Haven't seen it in a long time.
Yeah.
Not sure we will, but fingers crossed.
Yeah, it looks good on paper. Alexei Navalny.
Oh, brave man. I think one of the things to watch this coming year is actually going to be Putin. Ben Hunt is someone who I've spent a lot of time talking to. He thinks that this is a year Putin's going to come under some severe pressure, possibly regime change in Russia. So I think Navalny could be a kind of a pin in that balloon. So I think it's something to watch. It's not just about Navalny. This is about Putin too.
Yeah, I mean, you're talking about protesters going out in the depths of winter in Holland. I mean, let's talk about them going out there in Russia, right? And then
well, I think it's always the depths of winter in Russia. So I think they're made of stronger stuff than the Dutch.
Yeah.
All right, let's move to the next one with full employment.
Long ways away. Don't believe the U3. We're a long ways away. People want jobs in this country, and they're being kind of classified out of that participation. So we got a long road to recovery.
Cash.
Have more than you've had for a while. I think it's time to increase allocation of cash for sure.
Grant, on that note, is it physical cash or is it ones and zeros cash?
Look, I think one size doesn't fit all. Let's substitute liquidity for cash, and whether your liquidity is dollars in the bank or Bitcoin or gold, whatever it may be. But I think being liquid right now is a sensible, given everything we've spoken about and this potential regime change in the inflationary deflationary environment. I think it's being more liquid than you have been makes sense now. That's all.
All right, and then the last one for the final round here is international travel.
Looking forward to it again. Please. Yeah. I mean, I'm not stuck on an island like Mr. Williams here, but I do crave it. So that's something that I've always enjoyed. So I'm looking forward to doing it again. And hopefully in 2021.
Yeah.
Yeah. All right. And then the last one to wrap us up here for you, Mr. Williams, is central bank bubbles.
Getting ready to burst. I think this may be the straw that breaks the camel's back. I'm not saying it's going to happen imminently, but the fallout from what they're going to have to do for the next 12 to 18 months, alongside the fiscal side of things, may finally push them into that corner they've been painting themselves into.
Yeah, I think the first thing that has to happen is the bubble and hubris has to explode from central bankers, right?
We're good there. We're good for a while.
Yeah. So, but that one probably takes the actual crisis happening before they see any of their own ramifications. Yeah. So, Grant, this was awesome. We really appreciate you taking the time today. It's been a wonderful conversation. We'd love to have you back. You always have top of mind stuff. You put out good research. So can you tell our listeners where they can get in touch with the stuff you're putting out, with the podcast, your newsletter? Let our listeners know where to hear more from you.
Yeah, by all means. Thank you. I just relaunched my website. Finally, I've got everything in one place. You can find all that at grant-williams.com. You can find things that make you go home there. You can find the Grant Williams podcast there and a bunch of presentations that I've done over the years. And if you're so inclined, you can follow me on Twitter at TTMYGH.
Okay, and that stands for things that make you go, See, I practice. I got to use it
again.
It. So, okay. Yeah, thanks. So, again, this has been the Sherman Show here. We've had an excellent time with Grant Williams. You can see this on iTunes, SoundCloud, Stitcher, Google Play, Spotify, all kinds of stuff like that. We recorded this one in video too, so if you want to see Grant's smiling face, hunker down the Caymans with a COVID-free environment, you can go to youtube.com/DoubleLine Capital and check out the video along with that as well. Remember to follow us on the Twitter at Sherman Show Pod. Sam and Jeff Mayberry have launched a new podcast called DoubleLine Morning Minutes. So they're going to kick that off before the open every Monday. And of course, we launched Channel 11 last year. So like Grant, we're doing more stuff from our homes these days and trying to make sure we stay plugged into our clients. So again, thanks everyone for listening. Thank you again, Grant, for taking the time with us today.
Great pleasure, guys. Really enjoyed it. Thanks for having me.
All right, take care.